So good evening, everybody. Thank you very much for joining in. This is fourth in the series wherein we are going to speak about effectiveness of range forward in cash flow hedging program. Basically, we will speak about effectiveness of range forwards in options because range forwards cannot be done without options. Range forward is nothing but the sum of two options which both exporters and importers are going to use. Well, about myself, I am Rahul Magan, working as a corporate treasurer in EXL Services India, which is an Indian counterpart of a US Nasdaq listed firm, EXL Service Holding INC. And at the same time, I am a trainer in the various forums across the world, predominantly in Asia, and speaking for various forums across the world. Predominantly, currently, I am associated with almost 26 global forums across the world when it comes to speaking and writing engagement. So today, as I said, we're going to speak about the effectiveness of range forwards in cash flow hedging program. With this we are starting, and this is going to be a basic session. What do you mean by range forward and how an exporter and importer is going to cover the range forward. Today predominantly we are going to cover about range forward from exporter's point of view. Now let's start. Take a very simple example. What do you mean by range forward? Like in the first three videos we spoke about what do you mean by hedging. Hedging is nothing but selling and buying in anticipation. If you are an exporter, you are selling in anticipation that your currency would appreciate, and you want to hedge yourself when it is depreciating, or you think that the currency is going to be stable, so it is better to hedge right now. Now it is up to you, because basically there is no unique definition of hedging, or there is no unique definition of the period of the hedging. You can hedge yourself for 3 months, you can hedge yourself for 6 months like Infi, you can hedge yourself for 7 years like Cognizant, you can hedge yourself for 5 years like Genpact, and so on and so forth. So there is no unique definition that how you're going to hedge it. Now there, as we already discussed, that cash flow hedging program is predominantly divided into two parts. One is the financial cash flow hedging, second is the non-financial cash flow hedging. Financial cash flow hedging refers to all liabilities which you already have in your books. Take a very simple example: external commercial borrowing, PCFC loan, and all of these kind of things wherein the kind of liabilities you have already in the books. The second refers to the non-financial, wherein you do not have any liability in the book. However, these liabilities or asset would occur in your books at a certain period of time. Take an example: you are a corporate treasurer of IT company. You know that your contract is of 7 years. So because the contract is a 7 year, every year you're going to get a revenue of $100 million. 5 years down the line, again you get $100 million. So every year you're going to get $100 million. Take an example of SL Technologies Limited, the company whose top line is roughly $5 billion. They know every year the top line is $5 billion. So they hedge themselves at least 3 or 4 years down the line, because their projects are long-term in nature, and it is very important for SL Technologies to protect themselves from exchange rate variability. We have seen in the year 2013 when USD INR was depreciated by 25%. We have seen in this year also when USD INR turning out to be almost stable, or at a moment of time it is depreciating also, but the views regarding the appreciation because of the new government is not taking place. So in nutshell, it is predominantly important for corporate treasurers to hedge their receivables as to make sure that they would be able to save themselves from exchange rate variability. Now this is also very important for importers as well. As we earlier discussed, cash flow hedging can be done via various derivative instruments. Now, one form of derivative instrument is known as a forward contract. Other form of derivative instrument is your swaps. Third form is options. Forward is very simple. We already covered, and we again going to have a session on forward as well. When it comes to options, we know that in India, corporate treasurers are always reluctant to use options because of multiple reasons. One, they don't want to take a premium in their profit and loss account, and they may not be able to justify to the investors that why they are taking a big premium in their books. Secondly, there is a little or a shallow understanding that how you can amortize your option contract, how you can amortize the premiums which you are paying for your option contract. Third, people do not know how to amortize, and secondly, how to cancel the contract, because in majority of the times you may not get the money. So in that sense, you have to cancel it. Secondly, fourth, and the biggest issue is the central bank. Central bank of the country is highly reluctant when it comes to the usage of the option contract. So from India point of view, today we're going to speak about range forward. And range forward in India, which is Reserve Bank of India, is terming as a cost reduction structure. As per Reserve Bank of India, cost reduction structure refers to a structure wherein you have multiple options. Example, you are linking one option with second, like in the case of a range forward, in the case of a seagull, in the case of other options, and you're trying to reduce your cost. And if you're going to use the range forwards in India, then you have to pass a specific board resolution in India, which is going to certify that these person are eligible to take cost reduction structure in India on behalf of a company, which is of course Indian, right? What is range forward? Basically, if you're taking a forward contract, you're locking yourself at a rate. Say, take a very simple example. You are working as exporter in India. If you are working as an exporter in India, then you are selling your receivable. Say you are selling $1 million 7 year down the line, right? 7 year down the line. Today's spot is 65 and you are getting a premium of 5 rupees. If you're getting a premium of 5 rupees, your net output would be 70. So you have a right to sell your $1 million at a rate of 70 after 1 year. Now this 70 can be effectively utilized, can be cancelled, can be rolled over. It depends upon the condition. If we assume that it is going to be utilized, then assume by end of this period, the company, the exchange rate turned out to be 675 or 76. In that sense, company would have lost 1 rupee or 2 rupee as an opportunity cost. However, you can save this when it comes to option. You can save this because, as we earlier discussed, that there is a great difference between forward contract and option contract. Forward contracts refers to where you have an obligation. However, option contracts refer to where you do not have any obligation. Now take a very simple example again. If I do not want any kind of obligation, however I want to hedge myself, then what do? I'll go for an option contract. Like I earlier said, option means right, however not an obligation. But we are living in a world when there is no free lunch. So to get the right, you need to pay some premium. Now how you pay some premium? Basically, you can take options for 20 years. You can take option for 5 years. Generally in India, corporate treasurers are reluctant to take option beyond 3 months, because they don't want to amortize the big premium in their books. They cannot justify to the investors that why they are taking it. And secondly, the accounting for options is very difficult, is having a shallow base when it comes to India. In fact, majority of the companies we have in Asia do not understand what we mean by hedge accounting, and they are still using the obsolete fundamental when it comes to the hedge accounting. So these few are the basic flaws, or not in fact flaws, these few are the basic hurdles which are stopping people to use option. First, they don't want to take premium, they want to pay premium. Secondly, they don't want to amortize that. In fact, they don't know how to amortize that. Third, they can't justify to the investors that why they are taking an option contract of say 1 year down the line when they can take a forward contract. Fourth, their accounting, it's a very shallow understanding when it comes to the accounting of options. Now, what do you mean by options, as we already discussed, is basically categorized into two parts. One is known as call option, second is known as put option. Call option is for bullish people who are bullish. Put option is for bearish people who are bearish. Now, call option is predominantly for importers, put option for exporters. Call option means I'm Larsen and Toubro, I'm having a big contract for 7 years. I need to develop a power plant in Dubai. I need to consistently import the plant and machinery and everything in dollars, so I know I need to buy. So my objective would be, if rupee would depreciate, then I'm going to be nowhere because my margins are very shallow, which is 10% or so. Second, on the second side, put option is for exporters. Exporter means you are an IT company, say Infosys, you have a 7-year contract, you know that you will get the money. Now your client retention ratio is 99%. If you get the money, obviously you want to hedge yourself. Now effectively you have call option and put option. And if you would link this call option and put option, then you can create a range forward contract. How? Take a simple example. If I say I'm an exporter, I do not want to lock myself, right? However, I want to hedge myself. What do? I'll create export range forward, which is buy put and sell call. Now buy put means I have a right to sell to you, for that I'll pay premium to you. Sell call means you have a right to buy from me. It means you will pay me a premium, so it would be net off. Please be note that, as we earlier discussed, the concept of moneyness in option. At the money means at the money spot, at the money forward, out of the money, in the money. Now take a very simple example. Assume USD is trading at 62 and you want to create a range forward contract. But how do? You should ideally, as a corporate treasurer from export side, you should take a buy put contract at 58, which is out of the money, not deep out of the money. because you will get a right to sell at 58, although you know the currency is trading at 62. In that regards, you would be having the right to sell at 58. It means you will pay a little premium because you already giving a discount to your bankers that hey, currency is trading at 62 and I'm taking a right from you to sell to at 58. I'm already taking a discount of 4, so I'll pay less premium, and banker would be agree with the same. Second is the sell call. Sell call means the bank would have a right to buy from you or you will sell to bank. In that sense, if dollar turning out to be 62, you should take a buy put. You should take a out of the money sell call, which effectively means at 65. So the range is 50 to 65. If now we'll take 3 examples in range forward. If INR turn out to be 56, now in that sense you would have a right to sell at 58. You would execute this right, and you're going to execute your buy put. Now would bank buy from you at 65? If currency is trading at 56, definitely not. It's going to be worthless. What if currency traded at 59? You would have right to sell to bank at 58, which you definitely not going to exercise. You will sell in the market at 59. Would bank buy from you at 65 if the currency available at 59? No, it's going to be worthless. Now assume if currency is going to trade at 72, would you sell to bank at 58 if the currency is trading at 72? No. You are going to take it, sell in the market. Would bank buy from you at 65 if the currency trading at 72? Yes. Now bank will exercise that with you as well. In that scenario, if the currency trading at 72, you are not selling to bank at 58, it means effectively you are gaining 14 rupees. The bank will buy from you at 65 when it is trading at 7 rupee. So 14 rupee of gain, 7 rupee of loss, net you would be 7 rupee. So range forward is a kind of basically instrument which will help the corporate treasurer to save themselves from big volatility in the currencies. However, there is one weakness is range forward. The weakness is range forward is that if the currency turning out to be flat, because if currency turning out to be flat, say rupee would end at 58, you have a right to sell at 58. Obviously you will sell at 58. Bank will not buy from you at 65, so it would be worthless. If currency would be within the range of plus minus 1% or plus minus 2%, then range forward may not turn out to be effective. However, as we know that we are in an economy, or we are in a global financial system where currencies are getting highly volatile. So it is advisable from my point of view that all the corporate treasurers, predominantly those from export and import point of view, they should take range forward contract. When it comes to importer, which we are going to cover tomorrow, but let me give you a brief idea. Importers will definitely take for exporters, if we had taken buy put sell call, importers will take sell put and buy call because they want to buy. In nutshell, we are concluding that range forward is nothing but an option payoff. However, range forwards are further divided into 2 parts, which is exporter range forward and importer range forward. Exporter range forward refers to buy put and sell call. Importer range forward refers to sell put and buy call. Exporter wants to protect himself from exchange rate volatility. The range forward will help him to protect from downside as well as upside. The importer want to save themselves from the hike in this range forward will also save from downside as well as upside. At the end, would like to conclude that the options which we are taking is to value these options. You need to know few Greeks, right? The first is the delta, second is the gamma, third is the theta, fourth is the vega, fifth is the phi, sixth is the RHO. Delta is nothing but change in the option price into the change in the underlying. Gamma is nothing but change in delta to change in underlying. Change in delta to change in underlying. Theta is change in option price due to change in time. Vega is change in option price due to change of the volatility. Now here volatility means implied volatility, not historical volatility, not realized volatility. PHO and RHI means change in the interest rate. Now we know there are 2 kind of interest rate which we are using. One is the foreign currency interest rate, second is the local currency interest rate. So basically, once you are taking option contracts and you are running your corporate treasury as a trading desk, it is advisable for you to manage the options delta in an effective way. If the currency would get, if you have a big option book, There are various companies across the world who are running a big option book. In that sense, you should be able to maintain the delta or the Greeks of an option, because this will help you to protect yourself from M to M gain and losses. At the end,